I would reckon that houses, plumbing and home improvements are all capable of causing a fuss in the coming week, and that's because we've got the following results coming up. Half-year results from Bellway on Tuesday the 22nd of March, half-year numbers from distributor Wolseley on the same day, and then full-year figures from Kingfisher on Wednesday the 23rd. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's edition of our regular markets review, Breaking the Mould, I'm going to look at these three stocks and the key indicators you can use to analyse their results more quickly and easily. So let's begin with Newcastle headquartered Bellway. The FTSE 250 firm published quite a detailed trading statement back in February when the house builder's boss Ted Ayres seemed pretty upbeat. First half volumes were up nearly 12%, prices were up 17%, and the forward order book stood at around £1 billion, covering a good 6 months of forecast sales. That price increase was pretty stunning, and this chart here shows how Bellway's sales and volume figures compared to those of its peers, which is pretty well. The secret to Bellway then will be the forward-looking statement, since Ayres has already forecast 10% price increases for this year, lower than the gains seen in the first half. Besides that, you need to look at the trend in forward sales, the land bank, as acquisitions of new plots will determine long-term future sales, and also give the balance sheet some attention. Bellway's net debt of just £59 million, meaning it could add to a run of 19 annual dividend increases in the last 20 years. Last year, Bellway paid 25p at the interim, and analysts are expecting 93p for the whole year, against 77p a year ago. This all sounds so promising, but it does beg one question. If everything is quite so rosy, why has the share price fallen by nearly a fifth from its highs? It's a bit hard to tell as the stock hardly looks expensive on a PE of 8 and a dividend yield of nearly 4%, but perhaps, and I stress perhaps, the market's thinking, well, if things can hardly get any better, then if things can't get any better, maybe they can only get worse. So let's see, and one potential stumbling block to look out for is labour and raw material cost inflation, so watch out for any comments there. On the same day as Bellway's interims, we get first half numbers from trade, plumbing and heating distributor Wolseley, a member of the FTSE 100. This is an interesting time for the firm, which has just announced succession plans for both its chief executive and chief financial officers, at a period when its share price has actually slipped a long way from its highs. The reason for this slide could lie with worries over the US and UK economies, both big markets for the firm. The first quarter interim statement showed a slowdown in like-for-like sales growth to 3.2%. So the trend in Q2 and the first half overall will be important, especially here in the UK, where sales fell by just over 1% in the first 3 months. Note though that the US is actually 2/3 of the business. Also look for trends in gross margin, which rose to 28% in Q1, and trading profit up 6% during the first 3 months. For the full year, analysts are looking for around 8% profit growth. Now the last of our trio is Kingfisher, and that FTSE 100 firm reports full year 15 numbers on Wednesday the 23rd. The market initially gave boss Véronique Laury's 5-year transformation plan unveiled in January a lukewarm reception, but the shares have since rallied, so Laury will be hoping she can keep this going. For the full year, analysts are looking for a 6% drop in sales and a 1% increase in earnings per share to just over 21p, with an unchanged dividend of 10p. Where the company is also targeting 600 million of additional capital returns above and beyond the regular payments over the next 3 years. That's equivalent to 26p a share. Thank you for watching, and I look forward to seeing you next time.